Well, everyone, welcome. Thank you for braving the snow mounds around New Haven and making it in today for the talk. My name is Stuart DeCue. I'm the program director at the Yale Center for Business and the Environment, and this is the second talk in the Sabin Sustainable Venture Prize Speaker Series. The talk is sponsored, as I said, by the Yale Center for Business and the Environment. It will be broadcast simultaneously through the Yale YouTube channel. Welcome to those of you both in our audience here and online. A little bit about the Sabin Prize. It is it supports student and faculty efforts to start a sustainable for-profit business through cash prizes totaling $25,000. This venture prize competition and the application date for those here at Yale is March 22nd for everyone to get in their applications. Provides quality feedback from professional judges, extensive mentoring from faculty, and opportunities for participants to meet and pitch their ideas to top venture capitalists and leading industry professionals. Today we're really pleased on a number of levels to welcome Andrew Shapiro, a CBAE advisory board member, someone who is a serial entrepreneur and really a great friend of Yale and of efforts here to help create the kind of disruptive technologies and businesses which can translate into real environmental and economic change. In his talk, Scaling Up Innovation, Andrew will be addressing the new strategies available to increase the diffusion and commercial success of new technologies and business models. Andrew, as I mentioned, spent the last 2 decades working at the nexus of new technologies and societal transformation, with a focus over the last dozen years on energy and environmental innovation. He recently founded Broadscale Group, a new model of investment firm that is working with a network of leading energy corporations, including Duke Energy, GE, and National Grid, to invest in and commercialize the industry's most promising innovations. In 2000, Andrew founded Green Order, a strategic advisory firm that worked with more than 100 leading enterprises. He has invested and advised with more than a dozen startups. Fortune recently described him as green business's go-to guy. Andrew is a graduate of Brown University and Yale Law School and has held teaching appointments and research fellowships at Columbia, Harvard, and Yale, and he serves, as I mentioned, on the advisory board of the Yale Center for Business and the Environment. Please join me in welcoming Andrew Shapiro to the 2012-2013 Sabin Sustainable Venture Prize Speaker Series.
Thank you, Stuart, and thank you all for braving the weather to get here. I'm really pleased to be back at Yale. I've spent the day here today. And other than navigating my way through 8-foot mounds of snow on the sidewalk, it's been a pleasure to be back. You know, it is kind of fitting that we're having this discussion about new strategies to innovate around energy and resources at a time when last night in the State of the Union, President Obama spoke, I think, at more length about climate change and the need for energy innovation than he has probably in any of the State of the Union thus far in his presidency, and also at a time when we're just grappling with the reality of extreme weather events in our everyday lives. I mean, the fact that this area of Connecticut had 3 feet of snow over this past weekend is really kind of remarkable. So I think it's a wake-up call and a good time for us to have this dialogue and conversation. So I'm looking forward to it. I'm going to speak for roughly 30 minutes, give you a little bit of perspective on scaling up innovation as I think about it. And then I'm really looking forward to your feedback and your questions and a dialogue with all of you. So I hope you'll think about questions. I know some of you have already been giving thought to questions. You sent some my way that were really great ones. So I look forward to the conversation with all of you. So a little bit more about my perspective. I started a firm called Green Order in 2000 that worked with large companies and works with large companies today to help make energy and environmental innovation a source of competitive advantage. And we've worked with a really broad array of industries and corporate leaders, as Stuart said. There's just a couple of examples here on this slide, but more than 100 companies across diverse industries. We were very fortunate to start working with General Electric in 2004, help them to create their business strategy around clean technology called Eco-Imagination. Some of you have probably seen the marketing, but at its heart, Eco-Imagination was a business strategy to invest in clean technology and innovation around energy and environment. And so I'll come back to the work that we've done with GE. It's really central to where I've gone in my career over the last 7 or 8 years. I also have had the occasion to work on some other fun and interesting projects. We worked with General Motors on the launch of the Chevrolet Volt, which was really a pioneering electric vehicle. Worked with Silverstein Properties in New York on the creation of 7 World Trade Center, the first building that went up at ground zero, which was the first LEED certified office tower in New York City. And we worked with leading energy companies like Duke Energy and National Grid and others. So I've had the benefit of working across a variety of different sectors and seeing how large corporates think about these issues. And the reason I'm excited about this space is while there are great challenges ahead of us when it comes to energy security and environmental issues and climate change, there's also great opportunity. And that opportunity I see is the opportunity to solve our resource challenges using innovation. If we look at the fundamentals, and those of you who are here in the School of Forestry and Environmental Studies, you know all this well, but there are some key drivers that I think make this an exciting area to focus on for the next generations to come, 20, 30, 40 years. First, the sheer fact that our population is growing at such a huge clip, towards 10 billion people globally. The fact that 3 billion people will join the middle class by 2030. Tom Friedman of the New York Times likes to say that people all over the world are going to want to live like Americans. And while that's a great thing in some ways, it also means that the pressure and constraints on our natural resources are going to be huge. And that means that we must figure out new ways to make energy, water, forestry, other resources abundant, cleaner, and more efficient. And so I think that is really the task of the 21st century, and it's why I'm doing this work, and I'm sure why so many of you are as well. We need to innovate in how we produce and create essentially everything in our society. And that leads me to this kind of big metaphysical question, if you will, which is, what do we mean when we talk about innovation? We use that term so much, right? And I think it's worth stepping back and kind of asking ourselves, what is innovation really all about? Because it's easy to kind of quickly say, well, innovation, that's about technology. But it's about more than technology. It's also about culture. And it's more than just great big ideas, as I'll talk about further. It's also about having the courage to take action and to actually be willing to fail and make mistakes. So let's explore a little bit about how both big corporate actors and others are thinking about innovation. So leading companies are trying to innovate to solve problems. They see market opportunities. They see an ability to bring new products and services to market. They also want to improve their own performance, right? They know that if they can operate more efficiently, they can produce greater profitability, more enterprise value. They want to create products and services that the market wants, and by innovating, they hope to do that and ultimately increase market share and get price premiums and loyalty in the market. And they want better engagement with the marketplace. That means with public stakeholders, but it also means accessing innovation no matter where it may be. And so companies like General Electric and others are embracing this concept of open innovation. And even though they have huge resources and investments in their own R&D, General Electric, for example, across their global research centers has 3,000 scientists who do nothing but look at new technologies and applications. And that's outside of their business units where they have thousands of more technologists and R&D folks looking at new ideas. So open innovation is this concept of looking outside the four walls of the enterprise, whether it's investing in university research or looking at investing in new startups or working collaboratively with others in the marketplace. And this is a big economic opportunity. McKinsey put out a study last year saying that over the next 20 years, there is $3 trillion in economic benefit by improving resource efficiency in the global marketplace. So there's a lot at stake here and a lot of reason to focus for big companies on this area. These are big markets. At the same time, you've got some of the most talented entrepreneurs and investors who have gravitated into the energy and resources area because they see the same economic opportunity and because they're driven by ideals and values and they want to make a difference in the world. And that's incredibly exciting to me. I started in this space in 2000, sort of at the height of the dot-com bubble, and there were not that many people at that time who were kind of clamoring to get into clean energy or sustainable transportation or green buildings and infrastructure. But that has happened over the last 5 years. You've seen some of the best entrepreneurs who went from starting companies in the tech space into clean energy. One of the ones who I think people are talking about a lot these days is Elon Musk, who was a co-founder of PayPal and then went on to start Tesla and is also the chairman of Solar City. So you've seen this huge influx of capital, both from venture capitalists and private equity and project finance investors going into clean energy. And according to Bloomberg New Energy Finance, we're at about $270 billion last year. And while those numbers have kind of gone up and down a little bit, it's a huge amount of capital relative to what it was 5 years ago. And in many ways, on par with the investment that's going into traditional fossil fuel resources. And clean tech, even though it's had its tough time over the last few years, represents something like 1/5 of all the venture investment that's happening in the United States, and similar amounts abroad as well. As I said, there are new actors and participants coming into this market, folks who bring tremendous technological capability and scientific prowess, and I think that's exciting. And overall, you're seeing more new solutions, technologies, more new products and companies come into this space than ever before, and I think that's reason to be optimistic and sanguine about where we're going. At the same time, we have to be frank with ourselves, and I think this community sometimes is not willing to look hard truths in the eye. And the truth is, if you step back and ask yourselves how much progress has been made in clean technology and in clean energy over the last decade, the truth is we're not moving fast enough. If we look at any of the big areas, energy generation, green buildings, sustainable transportation, we're coming up with new products and services, but they're not scaling up fast enough, they're not commercializing, they're not reaching a mass audience. So I ask all of you, think about how many new companies or products you can think of that over the last 5 or 7 or even 10 years have gone completely mainstream in this space. And you can probably count them on one hand. When we get to the Q&A, maybe we can talk about some, because I'd love to hear if you can name more than 5. Most people can't. So why is that? First off, and here we are in the academy, we have to ask ourselves, are there failures of public policy? And I think most of us would say yes. Both on the international stage, I think the UN framework, while a good attempt has not gotten us where we want to go in terms of action on climate change. On the national stage in the United States, we also have not made the progress in terms of energy and climate policy, even though there have been some good attempts and some good efforts in specific areas like fuel economy. At the state and regional level, there are some more reasons to be, I think, pleased with the achievements that we've made. And particularly, I'm excited about some of the efforts that cities have made and regions have made, whether you look at the New England region or California. But there's also realities around economics, right? Most people know that with natural gas prices where they are, $2, $3 a million BTU, it's very hard for alternative technologies in energy and transportation, even impacting the infrastructure space, to compete. And so that's one of the realities of why a lot of these solutions haven't scaled up that fast. And then I always like to say, think about it, 2 guys in a garage cannot disrupt the power sector, right? Here we are, we're in the General Motors room. I don't think GM is concerned about 2 guys in a garage coming up with a vehicle that's going to completely upend GM. Now, GM has had other challenges over the recent years, but they're coming back strong post-bankruptcy. But if you think about our whole conception of startups and disruptive innovation, right? The whole history of it is really about the renegade entrepreneur. Think about Hewlett and Packard, who created the whole personal computer revolution at the start, or Steve Jobs and Steve Wozniak with Apple, or Bill Gates and his colleagues at Microsoft, or later, Larry and Sergey at Google, or Mark Zuckerberg at Facebook. These were all examples of, literally, in most of those cases, these were guys in a garage, not gals, but guys, but there are certainly stories of gals doing it too, who were creating new products and solutions that upended industries and created multi-billion-dollar enterprises. And we don't see that in the energy sector. We don't see that in transportation and water and waste and other sectors that are relevant to the issues we're talking about today. This has led a lot of the analysts in the sector to talk about this idea of a valley of death, right? And it's not just a technology valley of death where you're working to perfect a new solution or a new technology application. It's a commercialization valley of death, which is essentially a fancy way of saying that even if you can create the widget that will change the world, if you can't figure out how to get it to market, how to make it economical on a per unit basis, it's very hard to compete with the existing solutions. And that means for many new clean technology products and solutions that have been created, it's very hard for them to go up against the incumbent technologies. So all of this has led me over recent years to think we really need to step back and ask ourselves, what are we talking about when we talk about innovation? Because we get excited about new technologies and new ideas. But the truth is, if we think about innovation and what it really means in terms of its impact, innovation is about more than ideas. Innovation has to be ideas as applied and implemented at scale. I mean, it's a little bit to me like the story about if a tree falls in the forest, right? That old kind of koan, if a tree falls in the forest and nobody hears it, has it actually happened? That's the same thing with innovation. If you come up with a brilliant idea, but it is not implemented at scale, that isn't innovation. That's simply a concept or an idea or something that's on the drawing board which has yet to be applied. And to change the world, to make an impact, whether it's environmentally, financially, from the other perspectives that we might take, national security, public health, we have to take these ideas and apply them and implement them at scale in order to really make a difference. So let me then step back and tell you how we're trying to work on these issues at Broadscale. As we look at the marketplace of these new ideas, if you think about it, there are a lot of fantastic new technologies and companies that have been launched over the last 5 to 7 years. And in fact, it's been a fertile period. As I said, there's been more venture capital going into this space than ever before. There's been more project finance capital. Corporates are more involved. So you have great companies that are being created, great ideas that are coming into the market. But the truth is, very few of them are getting through this funnel of commercialization to the end. They may be raising capital, moving forward in their commercial plan, and getting to growth stage, but then they get stuck in this valley of death, as we discussed before. So what's the best way to actually drive impact? And we've been thinking about it, and we've come up with what we think is a new approach. Let me actually, before I get there, pause with a quick historical side note. Here, again, since we're at Yale, I can't resist but telling you a little story. And this is actually from a book written by my friend Stephen Johnson. And the book is called Future Perfect. Stephen writes about innovation and science. His last book was called Where Good Ideas Come From, A Natural History of Innovation. And he looked at what were the best mechanisms to drive progress in society. And basically, because he's a theorist about technology and innovation, he looked at historical examples, and he came up with this interesting example. This is the French railroad system that was created in the mid-19th century by a designer named Victor Legrand, who was commissioned by the French government to create a rail system. This was, of course, the cutting-edge technology at the time. And he created what can only be thought to be an incredibly elegant system and design for a national railroad. Highly centralized, very top-down, beautifully architected, but at the end of the day, not that efficient. And the place where that became clearest was during the Franco-Prussian War in 1870, when the French and German went to war on this eastern front of France, and the Germans had a huge advantage because they had rail lines that were far more decentralized. There were multiple redundant lines to get German soldiers to the front, and they were able to use those rail lines to get troops and munitions there faster than the French could, and most military historians chalk up the German victory in that war partly to the difference in the architecture of their respective rail networks. Now, we may have historians in the room who know better than I, but what I find fascinating about this story was that the best laid plans of the French in coming up with a perfect system for a rail architecture were upended by something that wasn't created top-down, that wasn't by design centralized, and was in fact quite hodgepodge. And Stephen Johnson says we need to learn from this and look at other systems that can actually be much more efficient in terms of scaling up impact and ideas. And the alternative, he says, is think about the value of distributed decentralized networks. And he actually fast forwards from the mid-1800s, the mid-1800s into the mid-1900s, almost 100 years later, to the work of a communications theorist named Paul Baran. Now, Paul Baran was a researcher at the Rand Corporation, and he was given a complex problem to solve, which was how do we create a communications infrastructure that can survive a nuclear bomb? This was just at the time when nuclear weaponry was being used for the first time, and the real scare was, based on the centrality of the communications network, could the entire network be taken down because of single points of vulnerability? And what Baran came up with was, rather than a centralized network, as you see on the left, or even a decentralized network in the middle with multiple nodes, was the value of having a highly distributed network, such as the one that you see on the right, where there would be no central node, or even not that many decentralized nodes, but multiple nodes and redundancies. Now, those of you who have spent any time studying the history of the internet know that Baran's work and this distributed network went on to influence and ultimately inform the very structure that created the internet. And so when people have talked about the internet was created to withstand, a nuclear bomb, that was Baran's work at Rand, which ultimately impacted communications and network theory and led to the creations of all the protocols that underlie the internet today. So I'm taking that historical detour because I want to talk for a moment about our theory on how to create and scale up innovation and how to do so in a way that will be most impactful and most efficient. And essentially, we are drawing from this network theory to say that we need another approach to think about how we take those great ideas in the energy and resource space and scale them up at impact. And that approach is one of relying on the power of networks. So rather than the historical model where companies have been funded and grown and then gone out to market to find customers wherever they might be, we are trying to create a structure that's network-based, bringing in a group of corporations who can be both customers for those new technologies and innovations, as well as sponsors in terms of providing capital to those companies, as well as partners in terms of commercialization, distribution, and other sources of value, manufacturing and licensing partnerships, financing. And, this is interesting, Outlook. Really key partners in scaling up these new innovations and technologies that are being brought to market. So we are borrowing from network theory to try to find a new way to accelerate the creation of clean energy technologies and ideas that can change the world. We're starting in the power sector, as I think I said earlier, with representation from GE, Duke Energy, the largest utility in the United States, and National Grid, which is the largest power company in the United Kingdom, but also owns utility assets here in the northeast of the US. But our aspiration over time is to go into adjacent areas. So areas like oil and gas and transportation and real estate and infrastructure and water and waste and food and agriculture and materials. And the reasoning there is that these clusters, while distinct industry areas, are increasingly overlapping. And the power will be in pulling together different companies across these industry areas into the kind of robust distributed network that Baran wrote about and ultimately helped influence the creation of our contemporary internet-based economy. And so what we're hoping to do over time is create a distributed network of large corporates who can help take these ideas and take them to scale. So our approach is what we call the formation of creative networks of collaboration. And this is a phrase that actually, I would say we, to some degree, borrowed from President Bill Clinton, who's been talking about the power of collaboration in networks as well. We added the idea of trying to make them more creative networks because we think that we need to go beyond traditional modes of collaboration and partnership. And by that, what do we mean? Well, the first thing is we're not just interested in putting capital to work in companies. What we're trying to facilitate here is, yes, capital, but also commercialization partnerships that can help accelerate these technologies, overcome that valley of death that we talked about earlier. If we don't do that, we know that a lot of these companies, even with a lot of capital, may not succeed. There are just too many difficult challenges in the process of scaling up these businesses, of finding the channels to market, of having the confidence of the end users in the market to go it alone. We're also looking to try to aggregate demand among different players in our network. So if we can pull together multiple companies that can share the risk, we can actually help technologies to get to market faster. In terms of network theory, the benefits to our members include greater efficiency in terms of transaction costs and information costs. They can share the burden of evaluating new companies and technologies. And they can also begin to share information amongst one another in ways that will give them greater insight and intelligence into the market and these new technologies. And then lastly, the kind of collaborative model we're talking about is one in which both the large corporate network members and the startup companies that we're working with benefit. Both sides get something out of the equation. And the best news is that there are positive externalities, meaning that society at large benefits, because if we can accelerate the deployment of these new technologies, they're all technologies that will help reduce environmental impacts, improve efficiency, and create a more sustainable economy. So our power network, which we've just started formally this year, has members of electric utilities, technology companies like GE, and then service companies as well that we're bringing in. We are looking at issues across the range of the power sector, from generation and transmission to smart grid and distributed generation, into issues around data and energy storage and emissions control. We're working with a whole group of resources and affiliates, including Pegasus Capital Advisors, which is a private equity firm in New York, which we're working with, public utility commissions so that we can help to educate regulators about what's happening, and other key organizations. We're working with EEI and EPRI in the power sector, as well as trade groups and NGOs and legal firms. And the way that we will activate the network is through these multiple different modes of action. So we're looking to drive co-investment from our network. So capital is a part of the equation, but it's, I would say, necessary but not sufficient in itself. We're driving joint ventures around technology and operations, including manufacturing. We're hoping to create distribution deals where larger companies can take the new tools and technologies that smaller companies are creating and help get them to market, as well as facilitating strategic procurement so that large companies can be working together to find the best technologies to meet their needs. Let me give you a quick case study to kind of make more concrete what I'm talking about. Recycle Bank is a company that I'm involved in. They actually acquired a small business that I started, and I'm on their advisory board. And they have done a really interesting partnership that's kind of emblematic of what Broadscale is all about. They're working with waste management. And let me just start by saying Recycle Bank, for those of you who don't know it, is a novel loyalty and rewards program that incentivizes people to recycle more. They've figured out a way to essentially quantify and measure how much consumers recycle and reward them for that with points that can be used at different retailers. And this company was actually named the #1 clean tech firm, VC-backed firm, by the Wall Street Journal this year and last year, so it's gotten a lot of attention. The partnership with Waste Management involves a number of different components. Waste Management made a major equity investment in the company. They've also shared with Recycle Bank a platform that they had in the loyalty and incentive space to do something different, so they sort of decided to go all in and bring those two solutions together. And then perhaps most importantly, Waste Management, the largest player in the waste and recycling space in the United States, is giving Recycle Bank the opportunity to have its solution sold in the marketplace by their own salespeople out in the field. And who knows better how to get these solutions activated with municipalities and cities around the world than Waste Management? They're the largest player there. So what we have here is a creative collaboration between a new player, Recycle Bank, that was bringing a new approach to trying to incentivize recycling, and Waste Management, the largest player in the field, which saw a need to work with an innovative external partner to come up with a new solution. And they're collaborating, and the results so far have been, I think, beyond their expectations. While I can't give you the exact numbers because it's a private company, I know from my engagement that the results are very dramatic in terms of reducing the sales cycle, the time to close contracts, and growing the number of customers that Recycle Bank has had. And so it's a good example of the kind of good outcome you can get when you put together a partnership like this. Another example I wanted to mention is Silver Spring Networks. Silver Spring is a smart grid technology company which is working with utilities around the world. It's been a leader in this space. And interestingly, just over the last year or so, they've forged two partnerships with large corporations. Both of those partnerships involved equity investment, again, but they didn't stop there. They also involve joint R&D and development of solutions and products to the market together. So with Hitachi, they are entering the international market, and particularly Japan. And with EMC, which is a company that focuses on the data space, they're developing new solutions around big data to analyze utility information and make it more valuable to their end customers. So it's another interesting example of how two large incumbent players are working with a younger company that's a leader in the space. And then the third one I'll mention is Tesla. And we talked briefly, I mentioned Elon Musk before, but when I speak to audiences, I often ask them, what's the most successful new energy or resource company or clean tech company, if you want to call it that? And people often say, well, maybe Tesla. They've had one of the most successful IPOs of any company in this space, and certainly have gotten a lot of press and mind share around the vehicles they've created. And one of the things that I think is notable, it's not often talked about, but they did this with the support of three major companies, which could have looked at Tesla as a competitor, but instead have embraced the opportunity to work with them, learn from them, take advantage of the entrepreneurial culture that they have. And of course, Tesla has gotten benefits from these relationships as well. As in the previous examples I mentioned, each one of these companies, Panasonic, Daimler, and Toyota, are strategic investors in Tesla. They invested at a key moment just before the company went public, so it gave kind of endorsement or validation to the company at a key moment when they were just entering the public market. But each has developed different strategic relationships as well around product development, joint R&D, commercial deployment, and so you'll see Tesla working with Toyota on their RAV4 vehicle, or you'll see them working with Panasonic on the development of new battery technologies. And these are the kinds of strategic partnerships that we think need to happen more, and for which there needs to be a more efficient marketplace. So in many ways, what we're trying to do at Broadscale is take these kinds of relationships that companies are forging with the most promising new startups in the space and create a marketplace for those kinds of partnerships that's more efficient, faster, and more dynamic. So really thinking about it in a clearinghouse model, imagine if there was one place you could go where you knew that you could get access to all the corporates that were interested in investing in or partnering with promising startups in this space. And it just today doesn't exist. If you ask entrepreneurs, if you ask venture capitalists, they'll say it's a very ad hoc process. It really increasingly depends on personal relationships that folks have, and it's slow and it's inefficient. We think that we can create, through the kind of network approach that I mentioned, a more efficient process, a more valuable process for all involved, reducing the time needed to identify and forge those partnerships, and ultimately accelerating innovation and the impacts that we're all looking for. In sum, then, I would conclude by saying that scaling up innovation, more than anything, requires new modes of collaboration. I think that what we're trying to do at Broadscale is one dimension or one way of driving that partnership and collaboration, but there are many more. I was speaking with some of you earlier today about the need to have government involved and the different modes and ways in which government can act, whether it's as a regulator or as a funder or even using its procurement power, and I believe that's a key part of the equation. We ourselves are focused on what I would think of as, instead of public-private collaboration, private-private collaboration, which is a key part of it. But I think that what we need to do today as a society to drive progress and change on these issues is do everything we can to forge new kinds of partnerships and collaboration that will unlock the opportunity that we know is there in these new technologies and solutions that people are developing. Only by tapping into that creative, entrepreneurial zeal that can be found in startups, and then connecting that to the unique resources that you can only find in large companies, whether it's the technological know-how, the customer relationships, the channels into the marketplace, and also, yes, the balance sheets of those companies, which have a lot of capital and cash available. Only through those two different components do I think we'll get to the place we need when it comes to scaling up innovation and achieving impacts. So I hope that some of you will leave here and go on to find ways to forge those partnerships. Maybe there are ways we can collaborate and work on it together. And I also welcome your ideas on other ways to achieve the outcomes that we're all looking for. Thanks very much. So let me open it up to questions. I know some of you have been giving some thought to questions and ideas because I got some good ones sent to me in advance, but I'd love to hear your thoughts and questions. And if you wouldn't mind, just tell me who you are and which school you might be affiliated with, if any. There's a mic there as well.
I'm Ryan Whitball. Joint degree, first-year joint degree student with School of Management and the School of Forestry. I was just wondering whether you anticipate creating partnerships between the growth companies themselves. Because I have the feeling that some technologies will have synergistic effects if those two companies are combined or work in a network with the larger companies. Do you anticipate that?
Absolutely. It's a great insight, and as we've spent a good portion of the last year talking to some of the smartest venture capitalists, entrepreneurs, and other kind of observers of the market, one of the pieces of feedback we've gotten is there are too many companies trying to do the exact same thing. Or there are complementary companies that have different solutions which would benefit by working more closely together or even merging. I think we're going to see more of that activity in the years to come. And part of it is that the nature of the venture capital model is that they want to launch lots of different businesses and see kind of who can get to the finish line. But in this market, you need more collaboration and less kind of cutthroat competition. So I think a lot of these businesses are figuring out ways to collaborate, and some of the exciting things you'll see will come from actors you might think are natural allies, and some from companies you would never have expected would be working together. Yeah, in the back there.
Hey, I'm Jeff Woodward. I'm a second-year joint degree student between the School of Management and School of Forestry. Traditionally in entrepreneurship, there's a little bit of hesitancy about partnering with a strategic investor early on because there's concern that it kind of limits acquisition opportunities from another strategic investor or creates other perverse incentives. You seem to be in some of these cases advocating for that. Do you think that there's somewhat of a different model here because of different needs of the space and that, or can you talk a little bit more about that, or how, as an earlier stage company that might want to partner with a strategic, how you mitigate that?
Great question, and that is a concern that entrepreneurs have. First off, I should clarify that most of the companies we're going to be working with, we call them startups, or really try to talk about them more as growth companies, because some of them have actually been around for some time. They just have had trouble scaling up. But most of them won't be early stage, because unless they are business model innovations, which don't have a lot of technology risk by nature, they're going to have to be working out the technology kinks and kind of going through that development cycle. By the time they get to the point where they're really ready to partner with a strategic, I think they'll be later in their development, and that probably will be less of a concern. And to be honest, as I've talked to folks in the marketplace, they are eager to embrace those partnerships because they see them as a huge opportunity. Now, it doesn't mean that they're not concerned about limiting their exit options or even their strategic procurement options, because if they get too close to any one large strategic, maybe others be concerned. But I've actually been surprised the degree to which multiple strategics are investing in the same company. Or, you just saw an acquisition that was announced, I think, this week. Toshiba announced it's buying a company called Concert. Concert has multiple other corporate strategic investors in the company. So right there, it blows that hypothesis out of the water. I don't know if they thought there were limitations, but so these things are happening in the market, and I think given the tough circumstances that a lot of these young companies are facing, they're going to have to figure out how they partner with strategics. Yeah.
Hi, thank you for joining us. My name is Rafael Torres. I'm a joint degree third year between SOM and FES. My question is, of course, in terms of scaling up innovation, the power sector is a doozy. And part of the reason for that is because you have these very large assets that are very long-lived, right? Mm-hmm. You have, when you talk about utility scale, generation, transmission, distribution, and so these assets are supposed to be online for 30, 40, 50 years, and you have long-term contracts. And so, of course, that dynamic lends itself to the fact that you have a very big installed base, and the amount that you install in any given year is kind of small. So that kind of makes it challenging for new innovations to break in on a bigger scale, because you've been locked out of all the existing installations that have already been put in place. How do you envision trying to get past that blockage without sort of recurring to the policy route, which is sort of stuck? You could kind of do it easier for the distributed generation side, but it's kind of much, much harder for the utility scale side.
Right. So this is a great question. Utilities are not easy to work with because of the regulated dimension of them. Obviously, there are a lot of investor-owned utilities that now have regulated and deregulated components, and one thing we might look at is where we work with these companies and where they try to deploy assets, whether it's on the dereg versus the regulated side. The other thing is there are things that are occurring, long-term trends that are going to, I think, dramatically impact how the industry thinks about innovation and change. Look at the rise of distributed solar as a trend. I think the utility industry is looking at that increasingly. Now, some parts of the utility industry are getting nervous about it. They're starting to see load that's being taken from them by DG customers. Some are pushing back on net metering laws. But that means to me that kind of where there's those kinds of concerns, there's also opportunities for forward-thinking utilities. And so DG solar is, I think, an area of interest. So is the whole issue of smart grid and grid modernization, where if we can figure out ways for utilities to be actively involved in that, then they won't be disintermediated by other players. But that's a real issue and concern as well. And so there are a lot of pain points, but also areas I think that bring opportunity as a result of that. And we're going to have to be creative in looking at the regulatory model and where we play in that sector. But I agree with you. Yeah.
My name is Ray, and I'm a second year at the School of Forestry. I'm interested in learning about how the relationship between, let's say, a strategic and a smaller company changes as they scale up. I'm interested in hearing your perspective about how the kind of carrots that each of these players pursue, the benefits that they pursue, change. I can imagine that for waste management, they, in a way, must admire the business model of Recycle Bank and, in a way, want to emulate it. And then as Recycle Bank scales up through using waste management's assets, maybe it'll run into different kinds of problems. So how did the benefits evolve?
That's a good question. Nobody knows exactly how these partnerships will evolve, but it's certainly conceivable that, as the smaller entity grows and if the partnership, gets close enough. I mean, there was an acquisition announced a few weeks ago where one of the innovative new companies in the sharing economy, maybe the best known one, Zipcar, agreed to be acquired by Avis. And you kind of think to yourself, well, that's interesting. I wonder why that happened. And I think one of the dynamics there was probably the fact that as Zipcar started to impact the market with this short-term rental model, other players in the market got into it as well, the big incumbents. So Hertz launched an offering that looked a whole lot like that, where they were allowing hourly rentals and doing it on campuses and so on. And I think Avis just sort of decided, they could partner with Zipcar or they could just acquire them. And they decided to acquire them. So I think you're going to see a lot more of that where, companies are going to have to make decisions as they partner and grow together. Do they stay separate? Do they acquire? Do they joint venture? But all of that should be ultimately in the name of getting those new innovations to market. Yes.
Hi, thanks for coming. My name is Will George. I'm a first year in the forestry school. And I was wondering, can you talk a little bit about the portfolio of companies that you have in terms of business model innovation versus technology innovation, and kind of, do you like a certain, percentage of each, and do the companies that you work with, are they looking for one more than the other?
Right. So I can't talk about any specific companies yet because we haven't announced any deals, but we are working with a number of companies on the growth stage side, and some of them are business model innovations and some of them are technology. And I think it'll continue to be a fair split of those two. The advantage of business model innovations, as I kind of referenced before, is that you don't have as much technology risk. And so they might be perfectly situated to partner with a large corporate to get more traction in the market because they don't present a whole lot of risk in terms of technology. Actually, the example I just mentioned would be a good one, right? Zipcar, they're not recreating the vehicle. They're not an electric vehicle company. They're not a natural gas vehicle company. They're not, even taking on the internal combustion engine in any way. They are a business model innovation. And thus, it was very easy for a larger corporate like Avis to get involved and acquire them because it wasn't, making sure that the technology worked. For example, a lot of EV car companies out there that have had some technological challenges with the battery and so on. So that would be a good example. But I think we're going to continue to see both. I think business model innovations often get overlooked in the whole discussion about, how we innovate and create change, and there can be powerful things happening there. I mean, look at what's happening in solar, where the manufacturers of solar have had a very challenging time over the last year, but some of the great success stories are coming from business model innovations around leasing, PPAs, this whole no money down model, and that's driving a huge amount of adoption in the market. Any other questions? Yeah.
I have another one. So I was wondering about the scale of capital, because again, power sector obviously very capital intensive, and sometimes this commercialization valley of death is framed as a problem of, there's just doesn't seem to be enough money to put at risk considering that particular risk profile. It seems like venture capital, you have different segments, right? VC, you have PE. Like VC wants to do, small investments, decent hefty amount of risk, but, smaller investments. PE wants to do bigger investments, but moderate to lower kind of risk. There doesn't seem to be a good space for large amount of money, large risk, which seems to be where a lot of these projects fall. So I was kind of wondering is there a gap there that the EPC sector hasn't seemed historically well equipped to deal with?
So I think that's absolutely right. There's a kind of middle ground particularly between kind of late stage venture and project finance, where you've got technologies that have been tested and proven at pilot scale, but which have not gotten full commercial deployment and thus have a difficult time getting bank financing, whether it's equity or debt. And so there's a need to finance those kinds of projects, and I think there are some new players who are entering that market, but you're right, the scale of capital needed to build large facilities, whether it's manufacturing or whether it's on the generation side, or certainly that's been true in biofuels and so on, can be hundreds of millions of dollars. The other interesting thing, though, that's happening is through these kinds of partnerships, you're seeing deals where larger companies that have that capability, both from a balance sheet perspective and a technical perspective, are partnering with the smaller companies to sort of say, outsource that activity to us. I'll give you an example. There's an LED company called Bridgelux that did a partnership with Toshiba. And basically, Toshiba had all of this excess fabricating capacity from semiconductors that they basically weren't using because of a change in standards. And they figured out that they could take what was unused manufacturing capacity and apply it to this LED technology. And so the two companies are working together, and it's a win-win because they've taken something that was an underutilized asset and applied it in a new area, and they've licensed that technology, and now they have a play in that space. So figuring out those kinds of partnerships where the larger player has the capital to put to work, but also the technological know-how or an asset that's underutilized makes a lot of sense. We'll go there and then there.
I'm curious about why you chose the power sector to start with, and what else you looked at,
Yeah. So, it's a good question. We also, I think I didn't mention this, but part of our philosophy is that this all has to be very relationship driven, and we have worked closely with those three companies that I mentioned, Duke Energy, General Electric, and National Grid, and at the C-suite level. And we believe that having the buy-in of a senior executive, ideally the chief executive of the company, is key to getting the kind of partnerships that we want to drive, because just the time it can take otherwise is kind of difficult to swallow. So that was one reason we started in that area. But we also canvassed a bunch of the other verticals that I looked at or I mentioned earlier. And there's interest from major players in those sectors as well. We just thought we need to start somewhere. And frankly, there's so much at stake in the power sector. I mean, it's obviously, from an environmental standpoint, the largest impact that's out there. And there's also another dynamic, which is probably obvious, but that's that utilities don't generally compete with one another. Because they're regulated entities, you can get multiple utilities working side by side. And even though I've worked in other industries like real estate and transportation and waste management, in those sectors there's more cutthroat competition. So the idea of having a GM or a Ford or a Toyota or a VW kind of partner in an initial network cluster seemed a little bit more challenging than getting a Duke and a National Grid, who are two of the biggest utilities in the Western world, but they don't compete. So there was a strategic decision there.
A little bit about the process between finding a growth company and connecting it to your partners, and what kind of screening criteria that you apply when you're looking at these new opportunities?
Sure. I mean, we're using a lot of the same criteria that any venture investor would look at. So obviously wanting to make sure that there's a strong team in place, that they've got good technology, they've got defensible IP or other unique assets. But because we're really looking at this from the standpoint of how we can scale up innovation, we want to make sure that the company has a solution or an offering that's really market ready. So if they're in the early stage of kind of working through the technology development and testing and piloting it, it's probably not going to be ready yet, unless, as we talked about earlier, it's a business model innovation, in which case it might get kind of moved to the head of the list in some ways because there's just less technology risk there. But by and large, we're looking for companies that have those good fundamentals and are solving a challenge or a problem that the large corporate entities in our network are working on. So I would say that's maybe the other distinction, is we're going to be very driven by the needs of our network, and venture capital generally is, what's the right way to say it, more supply side focused, right? They come up with, they have a technology or company that they identify. They want to make sure there's a good team and good technology, and then kind of only later do they often say, now who are we going to sell this to? We're going to look at it from the opposite direction. What's the problem that our network's trying to solve? And then who are the companies that can solve that challenge? Yes.
She from a first year graduate student from School of Forestry. You mentioned it before. I'm curious about, as Broadscale move to other sectors, how does the strategy will change, or the dynamics of the partnerships will change, and do you foresee any challenges?
Well, I think as we talked about before, the dynamics in each of these markets is a little different. The way I think about it, going back to kind of one of the images, I'll just show it to you again as we talk about it. We really want to think about this as one network, one big distributed network like Paul Baran talked about, with multiple nodes in the network. So power is a node, waste, water, real estate, transportation. But the idea is that you can pull them together in areas that are of common interest. So some of the challenges and issues that you're all familiar with, take electric vehicles. Electric vehicles would be an issue for the power network, for the transportation, or the power part of the network, the transportation cluster in the network, even the real estate cluster, because where are you going to charge these things, right? So increasingly, the issues that are most germane to energy and environment are at the intersection of these different industries, right? Take another issue like waste to energy. I mean, obviously that involves companies that are waste collectors and processors, as well as companies that need energy inputs and feedstocks. So a lot of these issues cross the traditional boundaries of industries, right? And that's the reason we want to create this network of companies from different industries. Stuart.
The power industry is dealing with a number of issues that you raised, particularly this lack of new technology that they can actually use and deploy. There's also a huge gap in terms of the people that are actually going to help run these industries. Do you ever view Broadscale as being a way to create a network of new leaders within an industry? And how would that actually germinate and come true? Because right now they simply can't fill the gap of people that they need to work in these industries and be the innovators.
That's a great question, and a natural coming from the head of CBAE, because it's true that these challenges and industries will need new leaders to figure out how these problems get solved. And I do think that, as I said earlier, innovation is not just about technology, it's often about the culture of the enterprise, and that's why we're trying to marry entrepreneurial culture to the assets that large organizations have. But it also means having the right people who will think creatively and in new ways about problem solving. And so I believe very much that there's a need to get new folks into these kinds of institutions. And too often you go into meetings at some of these companies and there's a attitude like, well, we've never done that this way in this industry, so why should we start doing it now? And the CEOs who I talk to are frustrated with that. They actually would like to see people who are risk takers and who are trying to drive change come into their enterprises, and they try to hire them. But it often is tough to get people to come into those industries when they've got other options available to them. But I think there are great opportunities for folks from, for example, the CBAE program and SOM and FES here to go into these institutions to be those kinds of catalysts of change and to be the ones who can actually drive it. Okay. Well, thank you all for your attention and your great questions. I've really enjoyed the dialogue and happy to talk to any of you after. Thanks a lot.